Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, the market is closed and I want to take some time to actually reflect on what is going on with inflation, this history of inflation and the interest yield going higher of the 10 years T-bill and basically growth stock. We have seen that they have been crashing. And we have two different philosophies, basically. We have, for example, the one of value investors like Warren Buffett, Michael Burry, who are, especially Michael Burry on Twitter, warned about this possible upcoming inflation stuff with the reopening of the economy and how it can have an impact on the market. Then on the other side, we have a more growth perspective of Cathie Wood, which actually is saying that in the long term, inflation should not be a problem. So who is wrong, who is right? We are gonna talk about that in this video. The only thing I ask you guys is please leave me another like, it's very important and I thank you for it. And subscribe to the channel so you don't miss any new updates. Let's begin. Alright guys, so in my opinion, the first thing that we have to look at is once again the letter of the Market Outlook 2021 from JP Morgan Asset Management. If you follow my video, you know that I have been talking about this, especially from this document, since basically before all of the stuff with inflation and things and interest yield happened. When they do these releases, I also encourage you to go there and read them because it's free research, free information, and in my opinion, it's high quality stuff. And if you remember, I read you this line, which in my opinion is very accurate with what we are seeing in the market. Inflation should also recover in line with the economy. Wage growth should be slow over the next few months, but then accelerate in the second half of 2022. This combined with the shortage of island seats, hotel beds, restaurant tables, and eventually apartments to rent could push inflation as measured by the consumption deflator above 2% in the second half of 2021 and keep it there in 2022. What that means is that we have just had a pandemic, more than 1 year, where basically everything closed. A lot of business, they went bankrupt. That's the reality. And you keep people at home. What happens when you reopen the economy? The idea behind it is that there is a moment where you have had a lot of businesses going bankrupt. So you don't have the same supply as you had before the pandemic. On the other side, you have people which they have been for more than 1 year, basically doing nothing, bored every day. Then finally you have this very dark event going away, fading away, with a combination of stuff which goes through pandemic away in summer period, which is probably even more explosive. Now, what can happen is to actually have an explosive effect on how people will react. People will probably want to go out on dinner, travel a bit, okay, doing stuff that they haven't been doing for more than 1 year, and that's perfectly fine. On the other side, you have the supply, which has been hit by bankruptcies and stuff. So this is why here they're saying that with the reopening of the economy, inflation can go higher. That's something that it can happen, as after a post-pandemic services consumptions surge, economic growth should once again slow later in 2022, and economic conditions may well begin to look remarkably similar to those that prevailed in 2019. Slow growth, relatively low inflation, and low interest rates. Now, here is what they're saying could happen after these first 2 years, this first year and a half of economy reopen. Basically, what they're saying is that after this first explosion, things will start probably to come back to a normal level. And on the part of the supply, which basically is meant by this kind of stuff, they will adapt and the supply and demand will meet again. And then this kind of stuff with inflation will then come back to a new equilibrium. And in my opinion, all of that is basically included the two different points of view. We have Michael Burry. In my opinion, what Michael Burry is saying is true. So it's kind of strange this, because I agree with both of them. So I agree with Burry, but I also agree with Cathie Wood. To make you understand this, and once again, it's just my opinion, is all of that. Because here is where Michael Burry is, while here is where Cathie Wood is. So we have two different phases, right, of this reopening. Now, first of all, Michael Burry he's making a warning here by taking actually the letter that Warren Buffett wrote to investors in the 1980s and kind of repropose this letter to today's environment. He's making a point that due to stimulus and stuff, with the reopening of the economy, inflation can go higher as a lot of people will start to spend more. And basically what he says is the effect that the inflation has on assets. Burry dredged up the letter to emphasize that if inflation ramps up, corporate profits today will be far more valuable than profits in the future. Now, what that means, this is basically the main impact that inflation can have on stocks. It's not a casual thing that during this crash we have seen growth stock getting dumped and value stocks actually going higher. This is one of the main effects that inflation has on stocks. This is from Investopedia, a very interesting article. Stocks are often broken down into subcategories of value and growth. Value stocks have strong current cash flows that will slow over time. So in the more mature state of the business. Growth stocks have a little or no cash flow today, as we see all of them are losing money actually, but are expected to gradually increase over time. Therefore, when value stocks using the discounted free cash flow method in times of rising interest rates, fear of inflation like what we are seeing right now, growth stocks are negatively impacted far more than value stocks. Now, this is pretty simple. It's the time value of money. Let's make an example here. If you take a value stock, very high cash flows today, and then you take an innovative growth stock that today is losing money, but the investment idea is that they will make a lot of money in 10 years, right? That's basically the idea when you invest in growth stocks. Now, if you add inflation to this equation, you understand that the idea of inflation going higher and higher in the next 5-10 years will make investors prefer cash today. That's why with the fear of inflation, what we have seen in the T-bill and stuff, a lot of value stocks, they actually went up and growth stocks went down. While when interest rates are low, basically what you have is that people will prefer cash in 10 years thanks to growth. That's why the past 7 months we have seen value stocks doing nothing, growth stocks literally explode. That's what has happened in the last week. We have the fear that we are going through this first part of the cycle, how the market reacts. Bond holders, they are saying, okay, the economy is reopening. You continue to push stimulus. You know what? I want to be invested in something that makes me a higher return. I don't want your bonds anymore. And this shift actually makes the interest yield going higher because they sense that the economy will go up, they sense that inflation can go higher, and they sense that the Fed could actually push interest yields higher. And that's why the market is actually anticipating the Fed in this case. It's kind of interesting. Another sign that is making us think that this first cycle that JP Morgan is saying has started is crude oil futures price. Now that's interesting. Here it was the pandemic. Look at that, futures minus $40. No one wanted the delivery. Look at how it rebounded. First cycle, 2nd of November, and since then, boom, skyrocketed high, basically with the vaccines news and stuff. We are at the resistance, lasted basically since December, since where we are over there, November 2018. What can happen? This is interesting because now we are in a moment where we have to see how much enthusiasm and how much fear our investors have about this upcoming inflation. As of today, we are in a phase where the Fed is still in control. Where can things become ugly? First of all, if you see the crude oil price actually breaking up that level violently in a short amount of time and continuing to go up, like no matter what, I go up, that could be a problem. Another problem, as I told you in the previous video, it will be that if we see the T-bill interest yield continue to go higher at that pace. Now, here it comes the second stage. Here it comes actually the idea of Cathie Wood. If you haven't seen the video that she posted yesterday on ARC, her idea is basically pretty simple. As this first phase of reopening and stuff will be gone, the market can come back to where it was before. In the long term, technology is a very strong force against inflation. Now, we have seen that historically has always been true. She's right about that. Because, for example, take a look at when the internet moved on. What we have cost reductions. Her idea is that basically with the continuous development of new technology in different sectors for different items and stuff, like for example, she points out in the healthcare business, genomics, screening, also electric vehicles, which they can put costs overall as they scale, probably lower than the normal automotive business. Anyway, all these technologies in the long term, they have a deflationary power because they are more efficient, have a lot of cost reductions, so they put prices down. And that's what she calls the good deflation, right? Then we have also, as she points out, and she agrees, the idea of Ray Dalio. Dalio points out the bad deflation, which is basically driven by the fact that as innovation continues to develop, we have old businesses which they haven't invested enough. Now they are stuck basically with a older technology. Now those old businesses will have to push prices down if they want to remain competitive. Otherwise, they just go out of the business. So that's the bad deflation driven by disruption, right? When you have this new technology going on, putting prices down, doing stuff better, more efficient, better products, the old businesses, or they try to become competitive, or otherwise they will not be able to sell anymore. So once again, another force against inflation. Another thing that she says, as I told you in the previous video, that's important is also it's not just the quantity of money, you have to look at the velocity. Just in the last data we have seen that the rate of savings, the savings rate, spiked up once more above 20%. So people prefer to invest instead of spending, and we see from the curve that went down consistently. So that's another point to look at, because remember the Japan case, right? If you see the Japan case, you have that they put a lot of money in the economy, but the velocity of money is so down that basically they never see inflation. That's another point that she makes. And interesting enough, she basically says that today's valuations of growth stocks with those high multiples and stuff, they can make sense if she's right about this fact of the deflation, because everyone thinks that overall the economy will have a nominal rate of around 4 to 5%, and that would imply price to earnings ratio on average between 20 and 25. But what if she's right about this thing with inflation? What if technology pushes inflation down, and obviously the economy in terms of real will slow down in the future, so that you have a nominal rate which is more near to 2 to 3% instead of 4 to 5. Then if you do 1 divided by that percentage, instead of having 20 to 25 price to earnings ratio, you will have 33, 32, right? So in order to justify higher valuations. Then she says, imagine if you have that, what will happen to those stocks that they are actually growing way faster than the economy. So that's her point, and in my opinion, I agree with both of them. As I told you, it's just, it depends on where do you think that we are in the cycle that I showed you. Michael Burry is here, Cathie Wood is talking about a more longer term. But honestly, it's difficult to understand who is right and who is wrong. And that's basically the best thing about finance. Finance is not a science. 2 plus 2 doesn't have to be equal to 4 all the times, right? It's not mathematics. Basically, it can be equal to 3 sometimes, it can be equal to 5, because the market is made by human. And that's why you have uncertainties. That's why you have risk. And that's why you're also able to make money. If everything was certain, you wouldn't be able to make money in the stock market, right? You are getting paid to actually hold a risk. So overall, what am I doing? As you know, I have been buying stocks. I bought the dip a little bit. I will continue to monitor T-bill rate, what the monetary policy will be, and I will also keep an eye on the price of oil. So because I think that that's an important key, because in the history we have seen that when you lose control of it, it's very easy to actually have inflation going higher. Because whether I know that everyone is talking about electric stuff, okay, I get it, but as of today, February 2021, a huge part of the world and the economy is driven by oil. Still, so we are not in that phase where basically we can replace it. That's why it's still very important. Anyway, I hope you find the video interesting, and leave me a like and leave me a comment below. Tell me, what do you think about that? Who is right, who is wrong, what you are expecting? Subscribe to the channel, and as always guys, have a wonderful day.